Once the market comes to break this level, it is suggesting to us that it wants to what? Go down. So if it goes back to retest at that very level where it broke, at that very level where the break in market structure happened, and it rejects off it and starts to drop, that point is referred to as a flip zone or a breaker or support turned resistance. We will go to live chat and I'll show you examples. I think this is GBP JPY. It's one of my favorite pairs. Very good. This is a bullish market. But what time frame is this? It's 4 hour. I would have to switch. I like to do the illustration on bigger time frames. Let me switch to a weekly or monthly time frame and show you something. Let me go back. I want a very good example so you'll understand what I'm saying. And I think I have a very good example here. So let me zoom in and let me show you exactly what I was explaining. I may have to zoom out and zoom in interchangeably because the chart is, I've gone back to somewhere 2013. So if I don't zoom out and zoom in interchangeably, you may not see the whole picture. Now, you can clearly see that this was one hell of a bullish move. Can you see it? How bullish the market was. One hell of a bullish move. Let me try to identify the swing lows and swing highs. This move started over here. This is what I was illustrating over there. Now look at something. You will not see it nicely drawn like I did in the illustration because sometimes market moves some way. So, but what I want you to identify, this is, let me key in the swing highs and swing lows so you get me very well. These are the swing lows and these are the swing highs. You can see it looks very close to what I was showing you. So look very well. So you can clearly see that this was a bullish market. It started over here. Swing high, pull back, swing low. Swing high, pull back or retracement, swing low. Swing high, 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 retracement, swing low. Swing high. Now see what happened over here. Very good. So you see, swing high, retracement, swing low, swing high, retracement, swing low. It continued happening. Now, bear in mind, this is a monthly time frame. So this is a lot of price action and this is a lot of money. From here all the way to the top here is how many pips? Over 6,000 pips. But as a retail trader, I don't think you would have stayed in this market for this long. That's more or less positional trading, which is done more often by the institutions, the big institutions. So look at the structure. Swing high, swing low, 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 swing high. Now see what happened later. Can you clearly see that this swing high, let's focus on the most recent swing high in this bullish move. Can you clearly see that this swing high got broken? If you can see that this swing high clearly got broken over here. And when I say it got broken, what I mean is price traded through that swing low and closed below it. Yes, you can all see that it got broken. Price traded through that swing low, this swing low, and closed below it here, forming another swing low. Now we don't have higher lows, we have lower lows. See what is happening. When it broke that swing high, it went back to retest it. So as a trader, let's say, when did this happen? This break, it happened on 31st August 2015. So let's say on 31st August 2015, you realize that the market had broken an important swing low. Immediately, it should suggest to you that the market wants to reverse. But the fact that it is suggesting to you that the market wants to reverse, it does not mean you should just enter and sell over there. To get a proper confirmation, we usually have to wait for price to go back up there to retest that swing low that got broken. Then that retest will be our entry. So look at what happened. After it broke it and came back to retest it, can you clearly see that there was a change in market direction? There was a change in market direction. The market started going down. It started going down. Then it started forming what? Lower highs and lower lows. Remember when I was talking about the bullish market structure? I said each high is higher than the previous high and each low is higher than the previous low. You get me? Each high is higher than the previous high and each low is higher than the previous low. Now, after it broke the market structure, look at what happened. Now, each low is lower than the previous low and each high is lower than the previous high. So this is clearly a change of trend, and that happened because the market broke structure over here. So this point is what we refer to as a break in market structure, abbreviated as BMS. You can also refer to it as a flip zone or support turned resistance. Some people also call it a breaker. All of these terms are used to describe the same situation. So it's very obvious. After the break in market structure came, price started to what? Drop. So there's no way you should see this and still be looking for buy setups. Once the market structure is broken, it's suggesting to you that the market now wants to trade down. So you have to be looking for sell setups. Now, like I was saying earlier on, we are teaching you the components of our strategy. So right now, we are teaching you the components. When we finish looking at each and every one of the components, we will now show you how to combine them and do analysis, starting from the bigger time frames and scaling your analysis down to the 15-minute time frame to get a perfect entry. So don't be confused. We looked at trading cycle, we looked at candlestick patterns, we looked at support and resistance. We also look at price and time analysis, and we look at the daily cycle again into detail. Then now we will show you how to start your analysis from the monthly time frame down to the 15-minute time frame where you can clearly see the daily cycle and then execute your trades intraday. So you'll be making profit on a daily basis. I think it's the best way for retail traders to trade. So you either trade intraday cycle or you swing. You can also scalp, but I don't really like scalping. It makes me feel nervous. That's just by the way. This is a bullish. Let's now look at how a bearish market structure looks like. Now, when we say it's bearish, obviously it's what? Coming down. So you have market doing something like this. So what we are considering is what happened from here to here. Forget about this for now. Let's concentrate here. Let me do my markings once. With a bearish market, these swing highs, once again, are acting as what? Resistance. These swing lows are acting as support. So look at what is happening. Now, these movements are called impulse swings. Some people call them impulse leg. They mean the same thing. So if you look at what is happening, the market is dropping from above like rain. It's moving in this direction. It's bearish. It's moving downwards. So you can see that the market creates a swing high, pushes down, forms a swing low, retraces up. Now, the up movements, the short-term up movements are called pullbacks or retracements. You can use any of those terms. They mean the same thing. When it goes in the opposite direction, it's called a retracement. So this is it. Swing low, swing high, swing low. Okay. Swing low, retracement, swing high. 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 So this structure will continue forming. The swing low, swing high, swing low, swing high. It will continue forming until there's a reversal or until there's a break in market structure. Then when that break in market structure occurs, it is suggesting to you that the market wants to what? Go up now. This was the initial move, a bearish move. But once the market structure is broken, it is suggesting to you that now price wants to go up. So if you look very carefully with this example, which is the market structure of a bearish market, the market is forming. Look at this low. Let me use the numbers again. This is 3. This is 4. These ones are on the same level. Good. So look, this is a swing low. This is a swing low, swing high, swing low, swing high. So if you look, let's concentrate on the swing lows for now. You realize that swing low 2 is lower than swing low 1. Swing low 3 is lower than swing low 2. Swing low 4 is lower than what? Swing low 3. What does that mean? It means in a bearish market, the market creates lower lows. We call them lower lows because each low It's lower than the previous low. So if you look at this low, it's lower than this one. If you look at this low, it's lower than this. And if you look at this low, it's also lower than that. And it's the same thing for the highs. So we have lower lows and what? Lower highs. Please take good note of these terms. If you understand market structure, you have to understand market structure, so it will help you know if a market is bullish or bearish. You have to know. So in a bearish market, we say the market is forming what? Lower lows and lower highs. And like I already explained, each low is lower than the previous low. Each low is lower than the previous low. That's why it's called lower lows. And each high is lower than the previous high. Each high is lower than the previous high. That is why it's called what? Lower highs. So as far as the market is concerned, this structure will continue to form until there's a break in market structure. This is our break in market structure. This is it. So you realize that swing high 4. Now bear in mind, the swing highs are acting as what? Short-term or intermediate-term resistance. So you realize that this move up here broke swing high 4. So once the move breaks swing high 4, it is telling you that there's a break in market structure. And a break in market structure is suggesting to you that the market now wants to go where? In the opposite direction. So once there's a break in market structure, most of the time, price will come back to test that very level where it broke and continue. Other times, it will come here. It will return to origin where the whole move started. Sometimes it will go past here and come here. So we call that return to source or return to what? Origin. Origin because that was where the bullish move originated from. So if it goes back there, it is called a return to origin. But I can say 7 out of 10 times, this is what usually happens. It will come back to test the very level it broke and continue going up. So the level that got broken is resistance turned support. It was acting as resistance over here, but once the market broke it and came back to retest and continued going up, it is no more a resistance level. That level is now a support level. So it's called resistance turned support or a flip zone or a breaker. This is what I'm talking about. The portion I've highlighted. This is what I'm talking about. So you can clearly see from this illustration that there was an impulse move up that broke this swing high. So later price came back to do what? Retest it, got rejected over there, then it continued going up. So this point should be your point of interest. Now, as you learn from us, you will learn how to catch the trade right from the reversal. So sometimes, if we don't miss the trade and we are on time, we catch it over here where the move started. Then when it breaks this level and comes back to retest, we enter more positions. I'll show you 2 examples of that. I remember very well because I took those trades. I'll show you an example on GBP USD that happened somewhere in June. It was a very sweet trade. Sweet, so sweet. Those type of trades are sweet, I'm telling you. This is what happens when there's a break in market structure. So that level is referred to as a breaker, a flip zone, or resistance turned support. You choose what you like. I like to call it breaker because it sounds simple to me.